Hi, this is Palmer coming to you from OptionsSpreadTrades.com. Today we've got a simple trading system to use during earning seasons. This is called a strangle. The way this works is we buy a put option and a call option on either side of the stock, and we hope because of the increase in volatility during earning seasons, when after an earnings report has come out, that the stock will move violently in one way or another. There's a few rules we want to look at to help stack the odds of success in our favor. Okay, the first thing is obviously we want to find a stock that's about to announce earnings in the next 3 days to a week. Second thing, we want to find a stock with a fair bit of liquidity. So the stock trading about an average of 1 million shares or more. Third thing, we want to make sure the stock is trading over $10. Fourth, we want to find a stock that has gapped at least 5 to 10% during the last 2 to 3 earnings. 5, we want to buy a strangle, which is an out-of-the-money put and an out-of-the-money call. Usually we want to buy one strike price out. So for example, if the stock is trading at $12, we would buy a $10 put and a $14 call. We want to buy options with at least 5 to 6 weeks with time value left. The reason is during the last 4 weeks, options generally tend to decrease in value, their time value the quickest. We want to use a 25% stop loss, and we want to close the trade out after the announcement, the earnings announcement has been made. As a caveat to that, if the trade is gapping in the direction of the trend, oftentimes it will continue going in that direction. So if you want, you can just set a trailing stop loss to hopefully capture more profits. Okay, so let's go ahead and take a look at an actual trade. As you can see, we are taking a look at RIM, Research in Motion Limited. They are the makers of the BlackBerry. Now they just announced earnings, and we recommended for our readers that they enter on the 22nd. Enter a strangle on the 22nd. Now we're going to take a look at the earnings for the last 3 earnings announcements, which was the 25th of September, the 25th of June, the 2nd of April, and actually why don't we take a look at December too, December 20th. Okay, so as you can see, they just announced earnings here on the 25th at the close of trading. On the 25th, it opened at $97. The next day, it gapped down and it opened at $77, a gap of $20. So we did pretty well on this trade. Our readers took about 107% in 4 trading days, or about an $800 profit. Now, if we'd followed our rules, we should have been paying a little bit better attention. But if we'd followed our rules, it was gapping in the trend direction, and as of close yesterday, about 5 trading days, it was at about a 257% profit, or it was about $2,000 profit. Okay, so anyway, why don't we go ahead and take a look at the past earnings. Okay, again, this was the earnings for the 25th of September. Okay, so we're going to scroll back, and as you can see, we had another earnings on the 25th of June, another big gap down. Here we opened at $140 on the 25th of June. And here it opened at $128, so that's a gap of about $22. Okay, so that's more than 10%. It's almost 15% gap, which is really good in terms of trying to play the earnings. Okay, and then let's see, what was the last earnings before the 25th? Okay, so we have April 2nd and December 20th. So why don't we go back to April 2nd? Okay, April 2nd, okay, not much of a gap, not much going on there at all. Not even a gap opening, so. But December 20th, another huge gap. So, that opened at 105, and it opened the next day at 122, a gap of $17, or actually about $16.50. Again, a gap of about 15%. Okay, so that's pretty good as far as playing a straddle is concerned. So that means 3 out of the last 4 earnings, RIM has gapped. So we're going to continue to play that as a straddle in the future during the next earnings. See, it announces earnings again on December 18th. So we want to watch that around, probably enter it around the December 14th, December 13th, something like that. So what we're going to do now is we're going to take a look at the options chart for the options chain for RIM. So what you're going to want to do, of course we don't want to do this now because RIM has already announced, but basically before the earnings announcement, we want to find we want to buy a put, okay, on one side of the stock and a call on the other side of the stock. Okay, so we want to buy 1 strike price out of the money if we can. Sometimes 2 strike prices is okay, which is what we did with RIM on this past trade. Okay, so basically you're going to want to find the stock trading in the middle of the 2 strike prices. So here the stock is trading at $61. Ideally, if it was trading, we'd rather have it trading at $62.50. And so it's right in the middle, but you can't always have it perfect. Okay, and then we have a $60 put and a $65 call. Okay, so that's a simple trading system that you can use. Let's just review. Again, we want to find a stock about to announce earnings 3 days to a week out. We want to find a stock trading on average about 1 million shares or more. We don't want there to be too much of a spread between the options price. So usually about a 20-cent spread, or a 20 cent on the bid-ask spread, so that it makes it easier to make money. We don't have to overcome the bid-ask spread. Then we want to find stocks trading over $10. We want to find a stock that's gapped at least 5%, preferably 10 to 15% during the last 2 to 3 earnings. We want to buy a strangle, which is an out-of-the-money put and out-of-the-money call, usually 1 strike price out. We want to buy options with at least 5 to 6 weeks before expiration. We want to use a 25% stop loss, and we want to close out the trade after the announcement, or if the trade is gapping in the direction of the trend, we can go ahead and put a trailing stop loss on that to continue to hold for even more profits. That's the straddle, or I'm sorry, the strangle for earnings, and you can actually use this on any big announcements. Some companies are announcing lawsuits. Some pharmaceutical companies are announcing FDA approval. So anything that's going to make the market volatile, or move violently in one direction or the other. If you want to learn how to make trades like this, or you want to follow our trades, please come visit us at www.optionspreadtrades.com, and we're more than happy to teach you. Again, this is Palmer. Thanks a lot for joining me. Have a great day and happy trading.